Most beginners think stock price moves because a candle breaks a line, news sounds bullish, or a crowd suddenly believes harder. But the actual mechanism is colder. Price moves when someone is forced to trade against the liquidity that is available right now. A buy order does not lift price because it is optimistic. It lifts price when it consumes the lowest sellers and has to climb to the next layer. A sell order does not drop price because it is scared. It drops price when it empties the highest buyers and falls into the next bid. Every stock has two doors. The bid is the door where you can sell immediately because buyers are waiting there. The ask is the door where you can buy immediately because sellers are waiting there. The price on your screen usually shows the last trade, but the live market is really between these two doors. If the best bid is $100 and the best ask is $100.01, the market is not one price. It is a tiny battlefield with two sides, 1 cent apart. The bid and ask are not guesses, predictions, or analyst targets. They are executable intentions, or at least displayed intentions. A bid says, I am willing to buy here. An ask says, I am willing to sell here. If nobody takes the other side, nothing happens. The book can sit there quietly while everyone has an opinion. Price prints only when patience meets urgency. Limit orders are patient. Market orders are urgent. The entire drama of price movement starts with that difference.
The spread is the gap between the highest bid and the lowest ask. It is not just a number. It is the immediate cost of demanding liquidity. If you buy at the ask and instantly sell at the bid, the spread is the toll you pay for speed. In liquid mega-cap stocks, that toll may be tiny. In thin stocks or stressful markets, it can become expensive. The spread tells you how much friction exists before your trade even has a chance to be right.
The order book is built by limit orders. A buyer posts a limit buy below or at a certain price. A seller posts a limit sell above or at a certain price. These orders rest in the book, waiting. They are the visible shelves of supply and demand. They do not move price by themselves because they are passive. They provide liquidity. They say, if someone wants to trade with me, I am here. The book is not a prediction machine. It is a queue of patience. Market orders do the opposite. They do not wait for a perfect price. They demand execution. A market buy reaches across the spread and takes the lowest ask. A market sell reaches down and takes the highest bid. That is why FINRA warns that market orders generally execute at or near current bid or ask prices, but the final price can change, especially in fast or thin markets. Market orders are simple to click, but mechanically, they are aggressive. They do not add liquidity, they remove it. The last price is the most recent footprint, not the whole animal. If the last trade was $100, that does not mean you can buy or sell unlimited shares at $100. It only means one trade happened there. The next trade may happen higher if buyers consume the ask, or lower if sellers consume the bid. Beginners stare at last price as if it is the market's center of gravity. Professionals ask a sharper question. What liquidity is available at the next price? Imagine the ask side as a staircase of sellers. At $100.01, there are 500 shares. At $100.02, there are 700. At $100.03, there are 1,000. If a market buy for 2,000 shares arrives, it cannot all fill at the first ask. It eats through each layer until the order is complete. The printed trades climb the staircase. That is how price moves up, not by magic, but by consuming the ask. The sell side works the same way in reverse. The bid is a staircase of buyers below the market. If a large market sell arrives, it hits the highest bid first. If that bid is not large enough, the order falls to the next bid, then the next. The last price starts printing lower. This is why a stock can drop quickly, even without new bad news. Sometimes the story is simple. There were not enough buyers at the top level to absorb the urgency. Depth means how much size is resting near the current price. A deep book can absorb a decent order without moving much. A shallow book moves because each layer is thin. This is why two stocks with the same price can trade completely differently. A 10,000 share order in a liquid large cap may barely matter. The same order in a low float stock can punch through several price levels. Depth is the shock absorber. When depth disappears, even small urgency can create large movement. Slippage happens when the execution price is worse than the price you expected. The usual reason is that your order walked through the book. You thought you were buying near the best ask, but your size consumed that level and filled the rest higher. Slippage is not always broker failure or manipulation. Often it is arithmetic. If the book shows 500 shares at the best ask and you demand 5,000 shares right now, the extra 4,500 must come from somewhere else. The mid price is halfway between bid and ask. If the bid is 100 and the ask is 102 cents, the mid is 101 cent. It is useful for analysis, but it may not be executable. You cannot assume you can trade at the midpoint just because it looks fair. In liquid markets, midpoint executions can happen through routing or hidden liquidity. In other markets, the midpoint is just a mathematical ghost between two real doors. Useful, but not guaranteed. At the same price, orders usually line up by priority rules, often price first and then time. If you post a limit buy at the best bid after thousands of shares are already waiting there, you may be behind them. The price can touch your level without filling you if the queue ahead of you absorbs the trade. This is why being right on price is not always enough. In an order book, position in the queue can matter. Liquidity has a line, and you may be late. Not every order is fully visible. Some traders use hidden orders, reserve orders, dark venues, or algorithms that reveal size gradually. That means the displayed book is important, but incomplete. You might see a thin ask, send a market buy, and discover more sellers were waiting than the screen showed. Or you might see size disappear before you can act. The visible book is a window, not the full building. It helps you read supply and demand, but it does not give you perfect X-ray vision. Market makers and liquidity providers quote bids and asks because they are willing to buy and sell, but they are not charities. They manage inventory risk. If too many people buy from them, they may raise offers, hedge exposure, or widen spreads. If too many people sell to them, they may lower bids. Their job is to keep liquidity available while controlling risk. This is why quotes can adjust before the crowd understands the move. The book is not static furniture. It is a living risk engine. Spreads widen when liquidity providers want more compensation for risk. That can happen around earnings, economic data, breaking news, low volume, volatility, or uncertainty. A tight spread says competition is strong and risk is manageable. A wide spread says the market is asking for a bigger toll. Beginners see a wide spread and think only about potential profit. Professionals see it as a warning. If it costs more to enter and exit, you need more edge just to overcome the friction. Volatility is not only emotion. It is also liquidity under stress. When urgent buyers and sellers arrive faster than passive orders can replace the book, price jumps. If the ask refills quickly, the market stabilizes. If it does not, price keeps climbing. If bids vanish under selling pressure, the drop accelerates. This is why fast markets feel slippery. The floor is moving because the available liquidity keeps changing. Volatility is what the order book looks like when patience cannot keep up with urgency. Stop orders are often invisible until triggered. A stop loss below price may become a market sell when the trigger is hit. One triggered stop may push price into another cluster of stops, creating a cascade. The same idea can happen above price with breakout orders or buy stops. This does not require a conspiracy. It is simply clustered behavior meeting thin liquidity. Traders place stops around obvious levels because those levels feel logical. The market moves sharply when many logical decisions activate at the same time. The order book can change before you touch it. Orders can be canceled, moved, refreshed, hidden, or routed elsewhere. Some displayed size is real, but temporary. Some size waits only if conditions stay favorable. Illegal spoofing exists, but you do not need fraud for the screen to mislead you. The book is a live negotiation, not a promise carved in stone. If you treat every displayed order as permanent truth, you will be surprised when the liquidity you trusted disappears at the exact moment you need it. Limit orders shape the book. Marketable orders move through it. That distinction is the core of market microstructure. Passive traders choose price and risk not getting filled. Aggressive traders choose speed and risk paying more. Every print is a tiny agreement between those two motives. If passive liquidity is strong, aggression gets absorbed. If aggression overwhelms passive liquidity, price moves. This is why volume alone is not enough. You need to know whether the volume was absorbing pressure or consuming the book. Order imbalance means one side has more urgency or less available liquidity than the other. If aggressive buyers keep hitting the ask while sellers do not replenish, price has to rise to find more supply. If aggressive sellers keep hitting bids while buyers step away, price has to fall to find demand. Imbalance is not just more green candles than red candles. It is pressure against available depth. A market can look calm until imbalance reaches the top levels. Then the move appears sudden. Retail apps make execution feel personal because the button is close to your emotion. You feel fear, tap sell, and price changes on the screen. But your order is only one packet inside a routing system. It may execute against a market maker, an exchange, or another venue, depending on your broker and market conditions. The danger is psychological. Because execution feels instant, traders forget the hidden machinery. They blame the chart, the broker, or the market before understanding the bid, the ask, and the book. Level 2 can be useful, but it is easy to misuse. Big bids can disappear. Big asks can be absorbed. A wall can scare traders without stopping price. A thin book can refill. The best bid and ask matter, but the speed of replenishment matters too. Watch how the book reacts after trades, not just what it displays before trades. The question is not, where is the biggest number? The better question is, when pressure arrives, does liquidity stand there, move away, or absorb it? Use this mental model. The bid is immediate demand. The ask is immediate supply. The spread is the toll for speed. Limit orders build shelves. Market orders remove shelves. Depth is the shock absorber. Slippage is what happens when your order is bigger than the available shelf. The last price is a footprint. Volatility appears when the shelves refill too slowly. Once you see this, charts stop looking like magic. They become the visible trace of thousands of small collisions inside the order book. A stock price moves because liquidity at the current price is consumed, canceled, replaced, or overwhelmed. That is the engine beneath every candle. News matters because it changes urgency. Psychology matters because it clusters orders. Institutions matter because size stresses depth. Retail matters because attention can concentrate. Market makers matter because quotes adjust with risk. But the final mechanism is always the same. Someone wants execution now, and the book either absorbs it or forces price to search for the next willing trader.